Hey guys, this one is the kind of summary of the two advanced models, right? So when I say the two advanced models, I'll be going through mainly Elliott Wave in the advanced model one, and I can't remember what we've actually got in the advanced two. Wyckoff basics, distribution, kind of Elliott order blocks, COT, right? So I'll just cover this, really quick in terms of a summary. I want to keep this one again very simple. This isn't a one video and it kind of, all you need to watch is this one. This is just the kind of how these things kind of fit together, right? So when I look at Elliott Wave, I'm going to use this kind of core image, right? This is the one that I put up the top in terms of how to learn. And this really is the summary, right? This is kind of how all these things kind of align and come together. So when you have an accumulation, right, we can assume, price rallies on up and we then get a distribution into the one. One comes back down for then a two, right? Now, a couple of rules in terms of Elliott is if number two comes below one, right, the count is not valid, right? It's not, and I guess logically speaking, the reason for that is something has changed, right? Something has happened to actually say, hey, this isn't what it seems. This isn't an impulsive move for whatever reason, right? So all you then do is you restart the count. Okay. The second golden rule in terms of Elliott is number two up to three cannot be the shortest impulsive move, right? Now, it doesn't have to be the longest, but it cannot be the shortest. So if we take 0 to 1 and 2 to 3 and 4 to 5, right? A lot of the time, what you'll see is one being relatively aggressive, right? Because this is like the inducement, this is the starting point. Number two will always come back relatively deep. And the reason for that is that we've had this kind of trending move down, right? And composite man, bigger players, they're going to want the retail players to think that this trend is likely to continue on down. Okay. So you tend to find this comes very deep, reversing at the last minute. Okay. Now, with that being said, if number three is the most aggressive for again logical reasons, is that if all the buying has been done down here, right, and then the bigger players defend that position to push the price up higher, as we break above one, you're going to see an acceleration from breakout traders, right? Again, like I talked about the moving averages in the last video, if you have this kind of move down and then we break up, come back and retest and go, the chances are you're going to have a lot more buy-in at this point, right? So again, all of the logic points towards why three, why the move 2 to 3 should be the largest, right? Sometimes what you find is the move 3 to 4 becomes pretty much sideways. Then you get a move which is kind of limp, right? This is where a lot of retail traders are kind of buying in, hoping that, prices are going to double again and prices are going to double again. And that ultimately leads to then, a much larger, more aggressive A, B, C move back down, usually into this type of area in liquidity, right? So this is where the liquidity pockets will ultimately sit. So that's kind of the second rule is 2 to 3 cannot be the shortest. Doesn't have to be the longest, but it cannot be the shortest, right? The last rule, and the only rule that I care about in terms of Elliott are these three, or the only rules are these three rules for this reason, is rule number one, 2 cannot go below 0. Rule number 2 is 2 to 3 cannot be the shortest, right? Again, something's off with the count if that is the shortest. Rule number 3 is 3 to 4 can't dip into the territory, right, from 0 to 1, which means if 4 comes down here, right, the chances are composite man, bigger players, they lose control at that stage, which then we have the ability to come back up for the retest and drop down, right, changing the whole sequence, right? So there's the three golden rules, right? Now, there's lots of other ones in terms of correction moves, and whether they're an expanded flat, running flats, whether it's a zigzag, all these different types of things. They also then will have different Fibonacci extension ratios. They will have different retracement ratios, etc., etc., etc. Right now, a lot of them, they are subjective. A lot of them are open to kind of your own interpretation. And the reason that I like only the three rules going to the impulsive move is it's a very mechanical process, right? It's the same thing over and over and over again. Okay. Now, bigger picture, part of the way that I trade, part of the way that Paul trades, is we're not interested in catching, exact bottoms, right? We're not looking for exact bottoms. What we're looking for is a bias up or a bias down, right? Now, at that particular point, we're looking at, monthly time frame, a 3-monthly time frame, a weekly time frame. We're not looking at this in terms of, the price has gone up in 2 weeks. That's not interesting to us, right? Truth of the matter is, if you understand where you are in this larger sentiment, this larger move, the benefit that you have is you're already on the right side of the trade, right? Simple as, right? Now, when you know what you're looking for, bigger picture, it's not a question of how do you now get in, right? That's not what Elliott is for. That's not what Elliott is, that's not how we use Elliott, right? This is where the mechanical videos, this is where the next kind of stage, the next process comes in. Once we get a change down here, right, we know that we've got kind of the safety net. At this particular point, we want to be seeing on a smaller time frame a move up, move back down, safety net, coming back through, confirmation, right? And again, reality is we also want to be seeing even this move coming back in to go again, right? And at that point, then what you have is you have the ability to take, pretty much this move, right, with a very tight stop loss. And this move is something that you can track for a week at a time, a fortnight at a time, a month at a time, 6 months at a time, right? So these are where these things start now to overlap. Now, when I look at this from an Elliott point, all I'm doing is I'm taking the bias, right? I'm taking the kind of the directional of the trade, right? Nothing else. Not interested in, what pattern this could be and what, what graph or chart or what fib extension. These are all things that you add on top of, right? This is like the refinement to those stages. So once you know that you've had some kind of an accumulation, you are kind of gathering data through this phase. You are seeing confirmation at this stage. You're entering at this stage, right? There's an awful lot of confirmation there, which, or it's cost me the move from the bottom. That's not the interest. The interest is making enough from this move to you, right, to take a year off. Right? You're looking for not a gamble. You were looking for something that you can copy, paste, repeat, right? Now, this is where on the smaller time frames, if you were to look at what I've been doing with Euro recently, the way that I'm viewing Euro is that we're in this kind of major downtrend, right? Now, there's nothing saying, well, you've got to keep short in this. What you're looking for is logic and reason to understand where you are in this bigger picture, to use that to your advantage in the smaller view, right, on that smaller landscape. Okay. So if I now move on from Elliott and I come into Wyckoff order blocks, buy before you sells and sell before you buy, which I covered in the last video. The general idea, right, is the market is always seeking liquidity. Right? So when the market comes from down low and we come up to the first high and then we start to distribute, the market's given you a good indication as to what's likely to happen next, right? If the market accelerates too fast, let me just put this on. If the market accelerates too fast, why is that not drawing? Try again. Right? When a market comes up like this too quick, or it's drawing behind the image. Let me move that out of the way. The issue that you have with something like this is that the liquidity, right, and the auction area is left down low. So you might see this hyperextension, but the drop is more likely to be a lot more fierce, picking up the liquidity they're left behind, right? Ideally, what you want is almost the inverse. You want the liquidity to be had, a move back up and a move back down, right? Grabbing the last kind of remainder of that liquidity to rally again, right? Now, inside that rally, you want to be seeing a similar type of move, right? And you want to be seeing an accumulation of sorts going again, right? And this is where a lot of people, fall over really, because the assumption that things just go up forever, right, is something that will catch a lot of traders out, right? Now, if you understand what the market has shown, what the market is showing you, you already know where the kind of the caps, the limitations, where they are. If you want to go and refine in terms of expanded flats, you want to go and refine in terms of zigzags and add in the fib extensions and so on, right? These are all things that you can add on top of that if you want that, right? Now, when I look at what's going on kind of across the board, right? And it's not just, it's not an instrument, it's not instruments, it's not just, oh, this is crypto or this is gold or this is, this is stocks. It's any asset will have its own kind of behavior, right? But the general rule of thumb is that most markets will follow this in terms of a core concept. Right? Now, when we look at liquidity, right, as I mentioned with supply and demand, if we've got this much larger time frame and the supply obviously is there, the issue being, as soon as that supply steps in, you're going to be looking for liquidity at the demand levels prior to the move, okay? Because you're going to have a lot of outside demand, right, outside of the channel that we've since created, okay? So when I look back at this euro example, we have this large area here, right, which clearly pushed supply down to new lows, right? So this now becomes the bottom. There's a lot of supply up there, right? But in the meantime, supply has technically moved down because we've got these tops here, right? Which means when I'm looking at this as a chart, I'm saying to myself, well, where are we? Without going into the Elliott count, I'm looking at this chart saying, well, what am I seeing? Am I seeing an accumulation here? Or am I seeing a distribution? Well, the reality is, we are pretty much pointing down. Right? We've had this major supply shift. Right? Demand has failed to make new highs. So where I'm at right now is we're either somewhere along, here or here, right? But to the inverse. So this is technically the 2. This is technically the 4, right? Now, without putting any count on, I'm looking for the price to basically continue on down, right? I'm talking about a monthly time frame. So what I'd like to see is instead of just saying, oh, well, that's my assumption, that's where I'm at, I'm looking for the methods to be able to repeat the process mechanically, okay? So at this particular point, my bias is, well, I'm short, right? But I'm not selling. And that's the big difference, right? You're not actually entered the trade in terms of, this is dropping down. The same thing, like I said, in any market, whether it's crypto, whether it's gold, right? These types of things are the same mindset, kind of over and over and over again, right? If it's not interesting to you, right, to your strategy, to your techniques, stay out, right? There's no harm in that. There's no damage done. The benefit of using these techniques then to drill down to the smaller time frames is I'm using this Elliott count. I'm using the logic in terms of 2 to the left, 2 to the right. I'm using the supply. I'm using the demand. These are where all these things kind of start coming together. Now, what I want to be doing is looking at the Wyckoff and the master patterns, right, in terms of what's actually going on inside of this move, which is where I can then drop down smaller time frame, right? Now, I'm going obviously monthly to weekly, and go weekly to daily, and go daily to 4 hour, 4 hour to a 1 hour, or even a 15-minute, right? And I'm just repeating that process until I've got enough confirmation that kind of puts me on the right side of the trade at a time that I'm happy to enter, right, with a bias in my favor. Right, so let's look at this in terms of Wyckoff. Now, in Wyckoff terms, right, and master patterns. Master patterns are basically a simplified version of Wyckoff, right? Now, when I say that, what I mean is you tend to have an accumulation or a distribution phase. You tend to have this center line, right? So the center line like this. Then what tends to happen is the price will come from above or below, right? It'll come into this range. It'll start to make kind of a sequence that looks a little bit like this, right? You start to see a move something like this inside, right? And it doesn't have to be exact, right? This is just, what you're seeing. As we leave the range, right, we're going to come into the expansion phase. Now, the chances are you're going to see a 50% marker to the upside, right? And then we start coming either here to go up, or this will break through, right? Similar kind of thing, back to retest. And then we start dropping down, right? Now, again, I'm not using this in terms of this is my trade, this is where we are. Although you can, right? It's not me, it's not this strategy, this is not what I use in terms of my own personal trading, right? This is something that, as long as I'm aware of, I know where these levels and these lines are, right? Now, when we're looking at this in terms of a Wyckoff, all we're seeing, right, is whether this is a buyer's climax or a seller's climax, depending on where the prices come from. We see, and then ultimately things like the UT, the UTAD, the move down, or we're ultimately waiting on that spring move up, right? Now, again, you don't always get a spring. It doesn't always have to work out exactly the same thing, but I'm not looking at this on the same time frame. I've dropped down the smaller time frames. So the chances are, if we were to assume that we were in this position too, right? If we were to see this move here, right, and then we kind of see this come up, we've still failed to take any new high, so no change of character just yet. We come down, right? Now, although you think, oh, well, this is now putting us in a downtrend move, right, because we're pointing down on the pullback of a move, okay? Now, once we start seeing this, the next thing you're going to see is a change of character to the opposing side. And this is really where, from the 2 to the 3, you're going to start to see opportunities if that is in the bias and the direction that you've already anticipated the move to be, right? So without going into too much depth, because like I said, I still want you to go and watch the videos in the advanced sections, both Elliott and Wyckoff. And obviously I'll come into the order blocks in a second. What I wanted to do was just to kind of put the logic together as to why the mechanical process, right? So everything from this is how I do the trend line, this is how I do the 2 to the left and 2 to the right, this is how I'm looking at a master pattern or a Wyckoff situation based on my Elliott Wave bias in terms of bigger picture, bigger directional bias. What I'm doing is I'm starting to build up a bit of a checklist in terms of, is it this? If not, no, move on to the next. If it is this, then right, move on to the next. What is this? Building up the kind of story so that when I enter that trade, I'm entering the trade with a lot of confidence and a lot of comfort, knowing full well that my psychology is managed with, good risk management anyway. And at that particular point, when you're right, you're making a good trade. When you're wrong, you're either sat on your hands or you're only losing that 1% in terms of the move anyway, right? So you're in a very good position. This, again, thinking like a professional, trading like a professional, rather than, I hope that, I hope that the asset keeps going up forever and a week, right? That's a gamble, that's a punt, and it's something that is very difficult to copy, paste, repeat, especially week in, week out, right? So in terms of understanding, the ins and outs, and in terms of Wyckoff is, it's a tool. It's useful to a degree. Is it useful on its own? I don't think so as much. Obviously, you're going to have to look at things like volume anyway. In addition, it's something that just gives you that little bit of insight in terms of the overall directional bias when mapped out with something like your Elliott Wave, right? Now, let's go from the monthly down to, weekly, from weekly down to daily. This is where the kind of the mechanical stuff comes in, right? This is where the last couple of videos I did on YouTube, and what I'll do is I'll put them into the educational section as well, just so that it's easy for everyone to find them and to kind of see them. So they're going to be a new tab again. And I'll create that tab probably just after the interesting lesson tab, right? So these are not different techniques. These are not different kind of styles. These things overlap, right? And these things you can kind of add and pick and choose in terms of what it is that you want. So as I mentioned earlier, in terms of supply and demand, I'm looking at the external supply, right, which obviously pushed down to here. The demand was pretty much, pretty basic, pretty bland, and therefore supply technically still in control. Okay, so this is the external. So in theory, all I'm doing is I'm turning this on its. I'm not sure if I can do this in trading view. I'd basically turn this upside down, right? So I'm not looking at an uptrend. I'm looking at a downtrend, and I'm looking at a downtrend with this kind of 5-wave count because it's an impulsive downtrend in terms of euro and what I'm currently viewing, right? So when it comes to things like order blocks, buy before you sell before you buy, obviously fair value gaps, all these kinds of things, a lot of the terms will lead you into smart money, right? And the smart money concept is something that, a couple of people have just coined as, oh, well, I've invented this. Truth of the matter is, these things all overlap. They've been in the markets for hundreds of years. No influencers come up with this as a concept. The general idea is when the price moves in a certain way, in a certain dynamic, then ultimately the price needs to come back. So, for example, the gap that you see in here, right, on a monthly time frame still, the chances are, price accelerated through, and therefore we're going to have an opportunity for buyers to come back into the market when we drop into that gap, right? And as you can see, we had a rejection pretty much from here. We're having a rejection as we speak from here, right? And therefore, I wouldn't be surprised if we come back down, fill the wick, come back down, fill the gap even, right? So take in some liquidity before ultimately coming back for another move up, right? So these things happen kind of over and over again. Now, in terms of liquidity, in terms of, an order block, in terms of the buy before you sell before you buy, if I was to drop down to a smaller time frame, right, so let me just put this on for a second, I'll show you, is I'm going to be looking, 2 things, 3 things, right? I'm going to be looking at this last red candle here, okay, before we ultimately moved on up, right? We didn't make a new high, which means, the chances are we at least retest there. We then have the gap, right? So this is the gap between the high of the candle before and the low of the candle after, okay? So this is where the clustering technique comes in, right? We didn't retest it there. We're now currently retesting this, right? So I could even now draw my little box saying my main area of interest is going to be in that overlap area here, right? I haven't put in any Elliott Wave counts. I haven't looked at anything Wyckoff related. There's no indicators involved. The core concept is this is overlapping. There's an area of interest, right? As I drop down the time frame, I can refine my position. I can refine the liquidity situation, right, by understanding what's actually gone on in and around that area, right? Now, I don't have to be accurate at this point because we know full well that the move that's changed the market, right? So this one come up, drop back down, and then we started making new highs. So the area of interest for me could be both candles here, right? That's one possible option, right? And again, this is kind of on you. There's no right or wrong here. You could refine this even further by saying there's that last candle there, right? And we move this across. So what I've got now is obviously a lot of information pointing towards the move kind of continuing on down, right? We're not done yet, right? Or not as far as I can see yet. We haven't really filled this in terms of a gap. We've currently taken liquidity below this candle, all right? So this there. And therefore, the chances are we come back down into at least this zone, if not one of these areas. We're talking about a monthly or a weekly time frame here, right? So this has got a long way in terms of movement, a lot of movement that could kind of continue on. But before I just jump in and say, oh, I'm going to go short and I'm going to go short for the next 6 months, I'm doing the same process again on the daily time frame. I'm doing the same process again, and I'm just following the logic all the way through, right, until I find a position that I'm comfortable to enter with. Now, when I say that, if you go back to the videos in terms of the mechanical structures, mechanical setups, the general idea is that obviously these things will allow you to take the entries on the smaller time frame with a higher risk reward ratio in your favor, based on the fact that we know where the bigger bias is, and we can then trade either counter trend or with the trend, depending on the time frame for your particular entry. Right. So again, order blocks: buy before you sell before you buy. They're areas of interest. You'll cover them, and we've covered them in obviously the individual videos. And I think that's pretty much a good enough summary in terms of a starting point, building blocks for you guys then to dig a bit deeper into the advanced 1 and advanced 2 lessons. And this is where Elliott comes into Wyckoff. Wyckoff ultimately is a representation of the master pattern. Or master pattern is a dumbed down version, as I said earlier, in terms of Wyckoff. And then obviously from there, these mechanical rules, the same way, two to the left, two to the right, magnetizing a trend line and just putting it so that you got a high, you got a low. Um, these things, these things are something that you use the same way, the same method, the same technique every single time. All right. Anyway, thanks for watching this, guys, and I will see you on the next video. This is the last one. The third one will be kind of almost putting all of this together, a bit of the summary there. And like I said, keep watching these individual videos, advanced 1, advanced 2. In the next one, it'll probably be a little bit more about the interesting lessons, as well as, like I said, kind of summarizing this as part of the bigger play. All right. Thanks for watching, guys.